Lohchab, who's joining us now to talk more. Varun, afternoon. Thank you so much for your time. Let's start by getting your take on the earnings so far. We are bang in the middle of it. The one sense which I got beyond the IT large caps or certain large cap banks, the biggies, if one were to look at the layer beyond the top 30, 40, 50 stocks, the earnings quality appears to be okay. What are your thoughts on the tally so far? Observations.
I think overall earnings season has been largely on expected lines from our coverage universe. The currently we are running at around 10 to 11% YOY earning growth, which seems fine for the kind of results which have come in. We believe this number will inch up a little bit as we go towards the end of the result season. In terms of sectoral performances, clearly banks has been a mixed bag. There has been some pressure which is visible on unsecured retail lenders in terms of credit costs being higher. But some of the large corporate focused banks have done quite well. So it's a but there is a overall pressure on deposit mobilization, which is hurting NIMs to an extent for some of the banks, and we believe that would continue. In terms of other large sectors, IT performance was fairly muted, but given the expectations and positioning going into the results was fairly benign, we saw positive stock reactions. If you look at oil and gas, I think that has been a standout performer. Some of the OMCs, upstream ONCs, companies in the gas space like Gail have delivered good earnings. And this was a sector which we had called out for last few months that, we are coming from very depressed base of FY23 earnings, and this would be a sector which will show the highest YY earning growth in FY24 and which seems to be continuing. So that has done quite well. Capital markets has done quite well. Real estate companies pre-sales have been quite good. So it's been a mixed bag. We believe capital goods by and large will be a good show. So largely on expected lines, consumption has been weak as expected. So no big negative surprises. And you are right in a way that if I look at the underlying quality of earnings, probably if I ignore the top 30, 40 stocks, it tends to get better because the benefit of lower input prices is starting to trickle down to smaller companies, and they are showing good earning growth on a YY basis.
Varun, there's one issue I wanted your take on, and that is battery companies. I know it's a very small universe here in India. Battery companies lately, till some time back, were only seen as the legacy battery companies. Till they, unveiled their own lithium and renewables plans. Some are turning recyclers as well. Till the extent that today something it's very remarkable happened. I saw one of the battery companies promoters who had abandoned operations of the company, active operations, for almost 10 years and became a politician, is now coming back saying that the battery operations of the company, especially in renewables, is at a critical juncture. How do you analyze the auto ancillary space and Indian battery companies in particular?
So auto ancillary space, we just came out with a detailed sector thematic, and we have been fairly positive. And again, we have reiterated a very positive medium-term stance on auto components as a theme. We believe multiple factors are coming together in terms of India now. Finally, the dream of being an global auto hub seems to be playing out. And we believe next few years we are going to see stepped up investments based on bottom up analysis. The auto component companies are going to invest $6.5 to $7 billion in the next 5 years in terms of capex, which is 2x of what they invested in the previous 5 years, which clearly shows the confidence of the sector. Premiumization happening across vehicles is leading to greater content for some of these component companies, which is an additional tailwind. Make in India and the PLI scheme is adding up. So I think overall, there is a sort of a positive tailwind for this sector. And battery companies, again, I think the starting point of valuations was very attractive 6, 9 months back. They got derated massively on the fears that everything would move to EV. But one, obviously the transition is gradual, and secondly, these companies are also trying to up their game on the renewable side. I think the same theme has been playing out even on the power side. Companies which were written off 12 months back on the fears that thermal is going away. We are seeing that those companies are back in action, because not only is the thermal capacity additions also required in a country like India where electricity demand is growing, but even these companies are increasingly moving their portfolio towards renewables, which becomes an additional growth driver. So I think there are opportunities across multiple sectors, multiple themes right now, and overall macroeconomy looks in good shape.
What is your top bet right now? What theme do you like most right now in terms of earning potential as well as valuation may not have run up? There is still room on risk reward is favorable.
So I think the bigger challenge has been on the valuation side of late, and more and more sectors are starting to look sort of slightly overheated on that parameter. But when I take a 2 3 year view, we are still positive on some of the themes which we were positive on. One was the capex, so both public as well as private capex, real estate, residential real estate demand. We believe is a multi-year cycle which will continue. Again, near term, probably stocks are a bit overheated and they need to consolidate for earnings to catch up. But medium term, yes, we believe incrementally we are getting more constructive on metals as a sector. Where we were underweight, we have been cutting our underweight out there. We believe it offers some value if there is a slight recovery in metal prices through sometime in this year. Some of the IT large caps seem reasonable on valuations. Some of the banks also seem reasonable. So it's a mixed bag. I would not say that one theme is dominant right now in terms of because the themes are well discovered and therefore valuations have run up. Now you have to be more selective, more stock specific across those themes, and you have to wait for some sort of bumps on the way in those themes, because it won't be a linear sort of a line up, and then you keep buying those themes. But I think capital goods, infrastructure, real estate, public private capex, these are, and manufacturing, I think these are multi-year themes from a next 3 to 5 year perspective, given how good the balance sheets are on both on the corporate side and on the bank side. But you have to play them and keep valuations in mind and not chase something which is too much in momentum and or where valuations are not in your favor. So that's the approach we are taking. Still have a slight value bias in our portfolio and not
It
going
should
for
be.
quality
That's how it should be,
at
Varun,
least.
isn't it? We are operating in the market. One has to be value biased. Very quick question. You may also answer it in yes or no, Varun. Consumer space has been languishing for a very long time. Some QSR names, pure FMCG, volume growth has been tepid. But is this the right time to get in there if one is a little patient? Because there the valuations are still, kind of okay. Or you would wait for more evidence that things are turning, only then would you come in? QSR and FMCG companies.
See, we are not overly worried on demand, slowdown out there. While there has been a demand slowdown, which is quite prevalent, more so on the rural side than urban. In urban also, we are starting to see some sort of deceleration of growth, be it apparels, be it QSR for last few quarters. But I still believe the bigger problem is more on the rural side, where recovery has been quite slow. But frankly, we are happy to live, and look through that sort of period of weakness had the valuations been very attractive, which is unfortunately not the case. And that's why for last almost 3 to 4 years, we have been running consistently the largest underweight in both staples and discretionary. And that still continues to be the case. So while valuations are looking better than what they were 2 years back, but they are still fairly expensive on absolute basis for the kind of growth that they offer, even on a normalized basis. We believe currently they are below normal in terms of growth rate, and growth rates will pick up little bit in terms of volume growth rate as we move through the year. But valuations are still not very attractive for you to make big money from a 12 to 18 month perspective. So that's why we are still sort of underweight on the sector.
All right, Varun, always enjoy chatting with you. Thank you so much for your time this afternoon. We'll take a short break on that note, but